Hello everyone, welcome back to another video. If you are new to this channel, my name is Farhan and I help POA students like you ace their exams. Today, we will work with the topic known as the allowance for impairment of trade receivables. In this question today, we'll understand the accounting theory, which requires us to account for impairment loss on trade receivables and prepare relevant journal entries at different times during the financial year. Lastly, we'll prepare the extracts for the statement of the financial performance and also the statement of financial position. You can see the question on the left hand side of your screen, and on the right hand side we have got all the workings which I'll go through and explain step by step. What I need you to do now is focus and follow through for an excellent understanding. With that being said, let's begin. The financial year end of Gerbil Limited is on 31 December. On 1 January 2019, the business provided the following balances: allowance for impairment of trade receivables of $2,005. The following information relates to its trade receivables. So here we are given a table which provides us the trade receivables at end of 31 December 2019 and also at end of 31 December 2020. Then we are given some additional information, and the first requirement is to use an appropriate accounting theory to explain why it is necessary for a business to account for impairment loss on trade receivables. So before we could answer that, let's understand some things based on the information given at the beginning of the question. So we understand that we are working with a business where the financial year starts on 1 January of a given year and ends on 31 December, which is right after 12 months. Also, on 1 January 2019, we are given the balance for allowance for impairment of trade receivables, which is $2,005. What do we understand by allowance for impairment of trade receivables? Allowance for impairment of trade receivables is a contra asset account. A contra asset account is an account which is prepared to record all the reduction for a relevant asset account. And the relevant asset account in this case is all the trade receivables or the credit customers of the business. So whatever uncertainties are involved with collecting the cash from your credit customers, they're all stored together in this account known as the allowance for impairment of trade receivables, and it is classified as a contra asset account. Always remember, all contra asset accounts by default must have an opening balance which is credit. This also means when the allowance for impairment of trade receivables increases, we always credit it, and when it decreases, we debit it. Now, based on the first part of the question, where we are asked to use an appropriate accounting theory to justify why a business needs to account for impairment loss on trade receivables, we can use the matching accounting theory, which calculates profits based on the revenues earned in a given financial year and the expenses incurred that we can deduct from these revenues that we have earned. Now, impairment loss on trade receivables in itself is an expense account. By default, all losses are classified as an expense because they are incurred in the generation of profits for the business, okay? And for us to accurately calculate the profit, we must include this expense, impairment loss on trade receivables, as part of our profit calculations. That way, we do not overstate our profits and also ensure that the matching accounting concept is followed. You can also utilize another accounting theory here, which is the prudence accounting concept. Now, the prudence accounting concept simply states that we should never overstate assets and profits, and we should not understate expenses and liabilities. If we include the impairment loss on trade receivables using the prudence accounting concept, we are ensuring that profits are not overstated and expenses are not understated, okay? All right, now let's look into part B. Prepare journal entries to record the transactions on 26th of July 2020. Narrations are not necessary. Now, what happened on the 26th of July 2020, which is additional information number 2. On 26th July 2020, Zhenhong Textile, which owed $368, was declared bankrupt. Zhenhong Textile was able to repay 25 cents for every $1 owed by check. The remaining amount owed had to be written off. So what do we understand based on this additional information? So on the 26th of July 2020, we know that Zenhong confirmed that they are able to pay 25% of what they owed us originally. Zenhong originally owed us $368. Therefore, the amount which we will receive from Zenhong is calculated at 25% multiplied by $368, which is $92. Now, the question clearly mentions that this $92 is to be received by check, which means funds will be deposited in the cash at bank account. Cash at bank account in itself is an asset account. When we are depositing funds into this asset account, our asset increases in value. And when asset increases in value, we debit it. So that is why we will debit the cash at bank account by $92 because we're receiving the check. At the same time, we know the original amount owed to us was $368, out of which $92 is what we're receiving. That leaves us with $276, which we need to write off. Every time we're writing off any balance that we are not recovering, we debit the allowance for impairment of trade receivables. So in this case, the allowance for impairment of trade receivables is to be debited by $276. Now, based on our discussion, which we had at the beginning of today's lesson, we talked about whenever there is a decrease in allowance for impairment of trade receivables, we debit it. So why is there a decrease now and why are we debiting it? Because we know allowance for impairment of trade receivables is a contra asset account, which is an account specifically prepared to record all the uncertainties involved with collecting the cash from our credit customers. So this allowance for impairment of trade receivables already had some amounts included due to these uncertainties. Now that we have got confirmation from Zenhong, we know that whatever credit balance was already stored there can now be reduced by the amount which we know that we are no longer going to recover, and that is $276. Therefore, the allowance for impairment of trade receivable needs to go down in value, and when it goes down in value, we debit it. Okay? At the same time, we will credit the entire amount of $368 which Zenhong originally owed us. Zenhong is no longer our credit customer after the bankruptcy has been confirmed and some amount has been repaid. So that means we will credit trade receivables Zenhong by $368 because assets are going down here, specifically current assets, and when assets go down, we credit it. So this is the journal entry for part B. Okay? All right. Next, let's see what's part C asking us to do. Prepare journal entries to adjust the balance of allowance for impairment of trade receivables for the year ended 31 December 2019 and 31 December 2020. All right. So at 31 December 2019, we first want to finalize the closing balance for the allowance for impairment of trade receivables, which can be calculated based on additional information number 3. Additional information number 3 states that the business, I apologize for that, the business estimates that at the end of every financial year, 5% of total trade receivables are likely to be uncollectible. Now, the total trade receivables at 31 December 2019 was $33,200. What's 5% of $33,200? It's $1,660, which is the closing balance for our allowance for impairment of trade receivables account. Now, if you see that at the beginning of the year, we had a balance of $2,005, right, on 1 Jan 2019. This means it is decreasing from $2,005 from 1 Jan 2019 to $1,660 at 31 December 2019. Therefore, whenever there is a decrease, there has to be a reversal of impairment loss. Because if there is a reduction in the allowance for impairment of trade receivables balance, it is actually a good thing, which is what we call a reversal of impairment loss. So impairment loss by default is an expense account, which we would always debit it. Now that there is a reversal, it is a good thing. Therefore, we have to reduce this expense and we would be crediting the impairment loss on trade receivables account. So that is why the journal entry at 31 December 2019 is to credit the impairment loss of trade receivables by 345 because our allowance is decreasing from 2005 to 1660. Always remember that every time your allowance for impairment of trade receivable goes down, we will credit the impairment loss on trade receivables because there is a reversal, which also refers to the fact that expenses are going down and it's a good thing for us. Simultaneously, we will debit the allowance for impairment of trade receivables by 345 because we have already discussed this before. When allowance for impairment of trade receivable decreases, we debit it because it's a contra asset account, okay? So this is the journal entry to perform at 31 December 2019. Now the question also requires us to adjust everything at 31 December 2020. To do that, we have to go through all the events that have happened and we will see what's going on. All right, so in the year 2020, so let's start with 1 Jan 2020, from the very beginning of the new financial year. So we know at 31 December 2019, the closing balance for allowance for impairment of trade receivables is $1,660. Okay? This is the opening balance in the new financial year starting 1 Jan 2020. Okay? So just remember that. So at 1 Jan 2020, we have an allowance for impairment of trade receivables of $1,660, which is obviously a credit opening balance. Okay? Now, in terms of events that have happened after 1 Jan 2020, the next event took place on 13th of April 2020. And this is the information given in point number 1, which says that on 13th of April 2020, Erica Crafts was declared bankrupt. Gerbil Limited decided to write off the full amount of $290 outstanding. All right. Okay. So if Erica Crafts declared themselves bankrupt and the full amount now has to be written off, what's going on? So when we know that we are writing off something, our allowance for impairment of trade receivable should go down based on the discussion we had in part B. So if allowance for impairment of trade receivables is going down, we will debit it. So why are we debiting the allowance for impairment of trade receivables again? Because allowance for impairment of trade receivables in itself is a contra asset account, which is specifically prepared to store all the uncertain amounts from our credit customers that we may not likely recover. Now that there is a confirmation, we know whatever amount was originally stored can now be reduced. And this is mainly happening because we are writing off the entire amount. So that's why, because the balance is going down, we will debit the allowance for impairment of trade receivables by $290, which is the entire amount that we're writing off for Erica Crafts. Simultaneously, we will credit trade receivables Erica Crafts by $290. Why? Because Erica Crafts have declared themselves bankrupt, which means they're no longer our credit customer or no longer someone from whom we expect some money or economic benefits. Therefore, assets are going down because they originally were our current assets. And when assets go down, we credit it. So at 13 April 2020, we would be debiting allowance for impairment of trade receivables by $290, and we would credit the trade receivables, specifically the account for Erica Crafts, by $290. So after this transaction has been sorted at 13 April 2020, we want to find the updated balance. So the updated balance at 13 April 2020 is the beginning balance from 1 Jan 2020, which was $1,660, minus the $290, which is mainly the reduction, as we have understood, and that leaves us with a new balance for allowance for impairment of trade receivables of $1,370 after the transaction has been sorted at 13 April 2020. Okay? All right. So next we've got the event which took place on 26 July 2020, something we have already solved in part B, right? So let me just scroll back up. Sorry to break your attention span. So 26 July 2020, we debited the allowance for impairment of trade receivables by $276 because this was the amount that Zenhong Textile, from additional information number 2, confirmed that they're not going to pay, right? So since the allowance for impairment of trade receivables is debited by 276, at 26 July 2020, we will take $1,370, which is the closing balance from 13 April 2020, and deduct this 276, which is the confirmation received from Zen Hong that they can't pay anymore. And that leaves us with a new balance for allowance for impairment of trade receivables of $1,094. Okay? The next thing is the end of the financial year at 31 December 2020. Now, the closing balance at 31 December 2020 for allowance for impairment of trade receivables is simply calculated by taking the percentage of 5 and multiplying it with the 46,740, which are the trade receivables we have got at 31 December 2020. So basically this means that we have got a total of $46,740 worth of credit customers. 5% of it is uncertain that we may be not collecting it, okay? So the allowance for impairment of trade receivables closing balance at 31 December 2020 is therefore $2,337 based on this calculation which we have done. So as you can see from the previous transaction at 26 July 2020, there is a substantial increase from $1,094 to $2,337, and the amount of increase is $1,243, right? Whenever there is an increase in allowance for impairment of trade receivables, what do? We credit it because it's a contra asset account, which means when it increases in value, we credit it, okay? And this is increasing in value, which is giving rise to an expense known as the impairment loss in trade receivables. All expenses by default are debited. That is why we are debiting the impairment loss in trade receivables account by $1,243, okay? So that is the final journal entry for 31 December 2020. All right, so now we can move to Part D. So Part D states that prepare an extract of the Statement of Financial Performance for the year ended 31 December 2020. So you'll be generally given all the fancy statements here at the beginning, which is Gerbil Limited Statement of Financial Performance extract at 31 December 2020. So I'm just writing things in short. So at 31 December 2020, when you're preparing the Statement of Financial Performance, which is also what we call the income statement, we will report the expense, which is the impairment loss on trade receivables that we have just calculated of $1,243. So we will report it under other expenses, impairment loss of trade receivables or on trade receivables, it doesn't really matter, of $1,243. Next, we are required to prepare an extract of the Statement of Financial Position as of 31 December 2020, which is also known as the balance sheet. Again, so I've just written extract of 31 December 2020 in short. You will be given the title in the exam, I believe. So in the balance sheet, what do we report? We report our assets. Now, trade receivables is a current asset, right? So under the current assets section, we will first include the original or the gross amount of trade receivables, which is $46,740 at 31 December 2020. Then we will deduct the allowance for impairment of trade receivables of $2,337, which was calculated based on 5% uncertainty multiplied with 46,740 of credit customers at 31 December 2020. That gave us an amount of $2,337, which when deducted from the gross amount of trade receivables of 46,740 gives us 44,403 as the net amount for trade receivables. And that's how you get exactly full marks, which is, I believe, 2, 4, 6, 10, 11, 13. So 13 out of 13. All right. Okay. So I believe you found value in this content. Make sure to drop a like and subscribe to this channel and share this channel with your friends. Also, in the description, there is a link to book a free Zoom call with me, where we will discuss your coaching and tuition requirements to help you prepare for your exams that are coming very soon.